Okay, so now that we've done our research, we've done our preparation, it's now all down to actually getting this down in a little bit more of a clear template so you can quickly revise exactly what you're expecting, exactly the previous language, and then also go over mentally the trades that you've got coming up. What action will it take to create a certain trade? This way you can visualize every trade coming up, and it alleviates any confusion, any hesitation when you actually come to trade the main event. So first up, I'd like to start with just get down the previous policy. This is exactly what happened previously, just so you've got that fresh in your head. So what happened last time? It was unchanged, just unch at 80 billion, and this was until March 2017. Now rates, as had been the case for a long time, totally unchanged. Now, what they did put in the previous statement is that they are going to benefit from staff projections, SEPs, staff economic projections. Also, they will possibly implement beyond March 2017. So that's therefore telling you from the previous statement that they said they were looking at the smooth implementation until and perhaps beyond March 2017. Now this is quite a standardised phrase from the ECB, so nothing too major, but certainly setting up, and the crucial thing was the benefit from the staff projections in December. So we know that December they're certainly going to be looking at more information, and in the past that has created some kind of movement. So expectations, rates, totally unchanged. No expectation of anything there. Stimulus, the broad consensus going into this meeting is plus 6 months. So that's going to take you out until September 17. Okay? Now, in terms of language, the way that it's released, as we've seen from previous, you're going to get a 1245 release. That's where you need to be looking out for the change. That's where any change is going to come, if any. And first up there, you're going to be looking at the extension and the size. So that's the area to be looking at. Size and duration first. So that's now giving us a sense of what we're expecting. Unchanged, 6 months potential extension. Therefore, that is the consensus. Anything less than or anything more than could potentially create a trade. Language-wise, 1245 is the time that we're likely to see this. Right, in terms of data, we looked at those charts coming through. The ECB at this period in time, not overly concerned with unemployment, so that's not coming into our heads too much. What we are still looking at is CPI, still below 1%, and it's pretty much flat for the year. So not great news on CPI. Therefore, any big change could be a bit of a surprise with the fact that CPI is flat. GDP generally has been up all year. So this is good news for the ECB. So we've got GDP up for the majority of the year. CPI, however, is still flat. So there we go. We're painting ourselves a little bit of a picture. They're the key things you want to take from it. Now, comments. Remember those source comments. First up, no announcement was the first comment. So we're not expecting anything here, or certainly no announcement on tapering. So any reduction in stimulus is going to be quite a big surprise, particularly based on what we've had from comments, not just the analysts' decisions or analysts' expectations. Next up as well, another possible opportunity for the ECB, they could change the capital key. Now remember, the capital key is how much they can purchase from each different nation based on their GDP, and also issue limit. meaning that they could buy more of a certain country's bonds. Remember, the issue was, or the worry was, that they were running out of German bonds to buy. And finally, they could drop the yield floor. Now, the yield floor meant that the ECB could not buy any bonds yielding below the deposit rate, which at the time, 0.4% negative. Therefore, remember the disparity between 2-year and 10-year German bonds. If they drop the yield floor, they would therefore be able to buy those 2-year bonds. So think about that for a trade. Now, in terms of this statement, what we're looking at is how things have changed. We know the majority of information is going to come at 12:45. What we're looking for in the statement is if there's any other areas that have changed. And this is all going to come about with the beginning of that statement. Now, remember, we looked at March 2016, January 2015, and it was all about the start. If at the start they begin by suggesting that they have conducted, we have conducted, this is going to give you a big clue that there's perhaps more to come, and then it's going to be a case of listening out as to what more is going to come. What has previously happened as well, they have listed the changes, and previously there have been 5 changes. Therefore, if they start with we have conducted, you then want to be listening out for what exactly has changed. Right, so we've got the information. These are the bits and pieces that we're going to be looking at on the left hand side. Next up is how we're going to trade, what we're going to be doing. So first up, get your levels straight. We're going to be looking at the Bund. So levels to the upside, we've got 161.52, 161.79, 99, and then 162.15. This is giving us around about 100 ticks of range. Now to the downside, it's a little bit trickier because of the fact that we've got a new contract. We don't actually have any levels really to the downside. So you're really looking at 160.92, 160.72, those previous 2 lows, and 160.54, that high volume node. So they're the levels that we're going to be looking at in both directions. The reason that you have these levels is if you are in a position, market's moving quite a lot, if you've got them written down, you can quickly glance over, see your levels, and then know whether you want to be holding on or looking to get out. If the market struggles, say at 54s on the downside, and doesn't drive straight the way through that level, perhaps you want to start taking a little bit off there. So think about all those different things well, it makes thinking about those things a lot easier rather than jumping to your charts, quickly trying to move your charts around, trying to find levels. If you're not going to find them right in the heat of the moment, it's going to cause a bit of panic, a bit of rush, and the likelihood of either getting out of your trade too early or holding on to a trade that clearly has met a decent amount of support or resistance and is likely to start to turn. Alright, next up, action. This is the big thing. This is where you can pick your trades and know exactly what they're going to do. So, first up, they could cut the stimulus. What could they cut it to? 70? 60? 50? None of these are expected. No cut is expected. Therefore, any cut is going to be a sell in the Bund. Remember, we're going to be looking predominantly at the Bund. This particularly hawkish. So that's trade number 1. So that's first out. If you see that cut in stimulus, you know exactly what you're going to do. Are you going to sell this full size? Are you going to sell it all at market? That's what you've then got to decide. For me, on something like this, this is one where you do want to be having a go at trying to do it full size. Next up, capital key shift. What are we going to do there? Now remember, the capital key is based around how much ECB can buy of certain countries. Now, The reason that they're considering shifting the capital key is because they're running out of bonds to buy in Germany. So if they shift, they can then buy bonds from other countries. Therefore, the trade here is going to be sell Bund, German bonds, and likely buy BTPs, Italian bonds. Reason being, money is likely to flow into BTPs. They are rather liquid compared to many of the other European bonds and also much higher yielding. So this is hawkish and dovish depending upon what you're trading. Ultimately, it is more of a dovish move. However, depending upon what you're trading in this scenario, bunds or BTPs, it's going to be a hawkish or a dovish scenario. Now, increase the issuer limit. What will this do? This allows them to buy more bonds, and it allows them to buy more bonds of any countries, particularly that scarcity in Germany. And where are people likely to want to place their money? In the safest assets. So this is going to be another buy bunds. Also, it could mean that there's going to be more money coming into the markets, into predominantly German banks, so it could also be a buy stocks trade as well. Dovish move, that one from the ECB. Extend duration. So that's what we're expecting. So, depending upon how much, and this is a varied outcome trade, if it is more than 6 months, you have a trade that is buy bunds. Also buy stocks, because QE is continuing. However, it's all then going to be down to, is it 6 months, is it 9, is it indefinite? And that's where the varied outcome element comes from. How much exactly are they going to do? So you've then got to start picking your trade on how much you're willing to buy of bunds or stocks, depending upon the outcome of this. If it's just 9, is it going to be that prolonged a trade? Are you going to be more benefited by getting in and getting out very quickly, as opposed to an indefinite increase, which is therefore adding much more stimulus and is likely to be more of a buy and hold situation? So dovish in any case, however, is a situation of assessing quite how dovish it is. Next up, you've got the unchanged. Total unchanged means that they have done nothing. They have neither decreased asset purchases, however, they've not announced an increase in duration. This initially would be a sell bunds, because the fear would be that they're not going to increase and they've only got one more meeting. However, there is always the likelihood of this coming back on the basis that they could still at the next meeting change. So this is more neutral, slightly hawkish comment. So again, that's where you then decide on the size that you're willing to go for on this trade. And finally, just going back to this comment on the yield floor, and a trade slightly away from what we're looking at trading, is if they drop that yield floor. And that is going to be a buy Schatz, which is German 2-year. Reason being, they can now buy them below the deposit floor. Schatz is currently trading around about the minus 0.8, 0.7 area, so they can then be bought. So this is dovish in terms of alleviating issues in the repo market. You could also see in this situation a small switching into selling bunds on this. So the trade would be to buy the Schatz and sell the bund, but that would most definitely be a spread trade. So finally, last things to be doing, you want to prioritize these trades. What are the trades here that you really want to have a go at? The trade that you're going to feel the most confident in, that you can visualize. I think that first trade, the clearest trade that is going to be very much an outlier, that you're not expecting, there's no expectations for it, is this trade here, the cutting in stimulus. That's going to be the big move. Next up, the increase in initial limit. Total opposite trade, very, very dovish. However, this is extremely unlikely. The ECB had already mentioned the difficulty in it. So that's a bit outlier. Next up, capital key shift. Again, this is quite a clear-cut trade and something that is potentially being talked about. Finally, you then got to assess the others. I'm going to cut out this final trade because of the fact we're only really looking at the Bund here. So it's the extending duration or the unchanged. Next up, I would say the unchanged. Again, you're moving down to the slightly more clear-cut trades, and then the extending duration. Because this is a varied outcome, because you're going to have to interpret this a little bit, that is, in a way, the fifth most important trade, certainly in terms of the risk that you're willing to take. So prioritize your trades in what you're going to look for. In terms of order that you're going to look for things, you are going to be looking at this first trade, followed by duration to start with. So slightly different if you look at the order that you're going to be looking at, but in terms of prioritizing those trades, you're certainly going to be looking at the cut in action. So that's how we'd look at it going in. You've got 5 trades there, you've got 5 scenarios, 5 things that you can visualize, you can run over in your head before the moment, and then when it comes along, you know exactly what you're going to do in terms of a trade, whether that is selling bunds, whether that's buying BTPs, buying stocks. You'll know exactly the size that you want to do, the prices that you're willing to get in at, and also, to a degree, how far you feel it might go. At least you've got some levels, as you've noted down, that you can start targeting to the up and the downside in either scenario. So that's how you want to be looking to template going into a central bank decision. Clears your mind, gets you ready for it, and alleviates any hesitation coming into the numbers. So let's go and have a look at exactly what happened. We'll have a little look at video. We will briefly comment on the euro as well, because we did have those charts up previously. So a brief comment on the euro, but also majority spent looking at the Bund and how that reacted and which one of these scenarios you could have actually traded. Alright, let's go and have a look at that video. Okay, so let's go and have a look at how this exactly traded, and we'll talk about a few different things that you do need to be realizing when trading central bank announcements. Now, first thing you want to be considering is the liquidity. Usually, when we're looking at the Bund, 400 lots is around about the expected size on the bid and offer. I mean, you could sell 400 at 161.05 and that would be fine, you would get them all. However, you can see above that it is much, much thinner. We're seeing a lot less size. Therefore, it means that you're going to struggle to get your fills away if you're trying to do any kind of decent amount of size. So that's the first thing to know, and this will happen consistently whenever you have any kind of pre-planned announcement, as is the case here. So that's the first thing to be thinking about. What we'll see now is exactly the beginning of the move and how we managed to get in on this. So I'll just get it playing and you'll see the announcement come up. Now the announcement comes up with 60 billion is the cut in the stimulus, and the extension is actually for 9 months, not 6 months. So we'll see that coming up as the move begins. Now, what you saw there is you saw the initial price light up at 0.8. So that was the first fill. Then further fills reduced this average price down. And what actually happened is managed to sell 0.8. Just get rid of this little bit of writing. 0.8, 00, and then the majority of trade was down here at 96.97. Because of the fact that it was so thin, you needed the market to slow a little bit so that you could actually sell some more into this market. So that's where the majority of fills got to. Now remember, on the move down, what were those levels we were talking about? We were talking about 160.92, 160.72, and then 160.54. So straight away you can see that we're straight through 92s. That was the first area. Now, being as we've only moved 20 ticks, that was pretty much expected, particularly as this news was definitely an outlier piece of news. It was not expected. As the sources had said, there was going to be no talk of tapering. So this was deemed by the market as a taper. We'll now go on and have a quick look. And like I said, remember those 60.92s, 60.72 I should say, and also 60.54 and how the market reacts around those areas. So down to 80s, 75 you get a quick bounce back up, and again a quick bounce back up. Now through 72s, and you see the speed pick up, and where does it stop? Straight down towards 50s. Second time we're through 50s, and you can see just how thin it is. We've got gaps now, very little in the market, therefore meaning that you really are going to struggle to get any more size in. But what you do have, and this is rather helpful if you are short, are large pieces of size chasing the market lower. What this means is if you're short and you want to get out, you could quite easily buy those 46s, getting you out of your position. So keep your eyes on where the size comes in and also what levels you're now breaking through. Remember, we're through 72, we're through 54, so half the position's gone. Initially we started off with 100 lots, we're now down towards 50, and we're through 52s, 54 area. This now gives you a chance to actually try and hold on a little bit, and also think about the size of previous moves that we've seen. Somewhere in the region of around about 80 ticks is quite a large move for the Bund. So we're already approaching the sort of 60-70 area. How much further can we go? And then, as I'll show you in a moment, a little bit of a telltale sign that perhaps the initial move, at least, has potentially ended. So we'll follow this on. We're now trading down at 40s, 35s, 30s, 27s. Now we're getting another flip back up. Now as we go through 25s, you see the speed really pick up through 20s, and then we flash down a full 25 ticks there. We drop from 20s pretty much all the way to 90s, so down to 95, 90 area, pretty much all in one go. This has clearly been the biggest one instance move that we've seen. That for me is often a pretty big clue that that could be the end of the move, particularly as we've now done over 110 ticks to the downside, which is a larger than perhaps expected, or at least for the first part of the move. So this is a pretty good clue that you might want to start getting out of position down here, covering some of your position. Next up, what you've then got to start thinking about is what the market's going to do afterwards. And this, if you're not in on that first move, does provide you with further trades. What you need to be looking at is where the market bounces to, where it then starts to hold, and you'll notice this in smaller ranges. That way you can actually start distributing orders around and taking advantage of perhaps a 10 tick range. Now if you can keep taking that 10 tick range, you get a little bit more money out of the market on your initial trade if you're in on that, but also it gives you an opportunity even if you didn't get in on the initial trade. And this is often the case, particularly on these more sort of binary, very clear-cut trades, that often that first move is quite a difficult one to get in on. So the second part of the trade can actually be just as important as that first part where you jump in on that first initial piece of information. Now before we continue, we'll just have a little look at the euro. Now what you'll notice is the Bund, after that very quick drop down with 30 ticks down towards 159.90s, the euro is still sitting at its highs up around 108.75 area. Now this could potentially be telling you something. As would be expected, in a situation whereby stimulus has been reduced, the euro has risen, the bunds have fallen. This is because of the fact that the reduction in stimulus is effectively creating higher rates, hence why you're seeing bunds sell off. There's less demand for bunds, and yield wise that creates a higher yield. Equally, that then creates a demand for euro, hence why we're seeing the euro strength against the dollar in this instance. So keep your eyes on the euro as well. The euro can often give you a hand in assessing how much more is in the move or how much less is in the move. And so what we'll see as we continue onwards is the bund continues to bounce, and now the euro is starting to pull back. Bund's back above the area where you got that final flush out, so back above these 20s, and the euro is now starting to come back as well. So now, if you've not been in on this move, you're now trying to assess where the market's stopping at, where it's actually sort of reached up to and is pulling back to. And we just saw it up towards 44 area, and now it's started to come back down to those 20s. So remember, those 20s very important. You're seeing a little bounce again from the area, and being as it's post an event, the markets are still very thin. You've got to be very aware of areas as opposed to specific prices. So you're looking around about 20s. You're also looking in the low 40s as an area. So you have to adjust the way you trade a little bit. If you're looking for specific prices, you're likely to struggle. Whereas if you're looking for an area, say perhaps around these 42, 45 area, that's where you can start looking to get in. Now remember, we had that level up around 52, 54 as well, so that's offering you a little bit of resistance. Once again, we start to come off from the low 40s, and then it's a case of note where we then start to fall to. Back down to 30s, and the euro at this point, note how far down we've gone. We're now trading at 108.13s. So the euro is going the total opposite direction now. Come back off 60 ticks, and this is perhaps giving a little bit of strength to the bund, hence why we're now bouncing from around about the 30 area, not from the 20s. So if you have sold these 40s, 45s, you can see that we're struggling at 30. You can now start thinking, right, I need to be getting out at 30, not looking for the 20s, because they don't seem to be coming. So again, we trade up into the low 40s, the low to mid 40s even, and we start to come off. But you can see the market is now struggling. Traded to 40, and we consistently seem to be holding 40. This is perhaps again another clue. There is a bit of strength coming into the market here. Quick drop down. So we're back down to those 30s, in another area perhaps now start considering getting some of your trade off. The fact that we've been up to 40s and we consistently hold in 30s gives you a little bit of an after the event range that you can start trading within. So there are some of the things that you really need to be thinking about. It's not just the trying to get in on that very, very first move. That gives you the biggest opportunity, of course, but it also gives you the hardest opportunity in terms of speed. You've got to have it very, very well visualized exactly what you're going to do in that situation. If you've got that, then of course it does make that easier, and you can see how quick we managed to get in. The market started trading around 161.13. We were all in 100 lots by 160.97. So that was still a 16 tick move to get in. However, we got all in, and then you can start taking off as you start hitting those levels to the downside. It's then a case afterwards of where you're going to trade around, what areas you're going to be looking for, and you can see this in every market. Each market will flow between certain areas, and as I say, think about it in terms of areas. Specific prices are less likely to trade exactly to them. So if you were selling 42, you see it push through, so you perhaps have to have a slightly wider stop. So these are the things that you need to be considering when you're trading central bank events. It's what the initial move does, followed by where the trading opportunities are afterwards. It's not a case of just stopping if you don't get in on the initial move. And then we do see further trade afterwards. Again, back down towards those low 30s, and we start to struggle. We continue to struggle in those same areas. This is perhaps a point now where unless you're short in the mid 40s, using this 700 as a bit of protection so you can have your stops above, then you can start thinking, right, this really is now struggling to get into those low 30s. You see it trades up again to 45. 700 got a lot of the order that they wanted, and now we're seeing it struggle to come back off again. So this is an area where I'd be considering getting out of the majority of my trade, so as not to run the risk that if we start moving through 45, are you going to see a quick move up? And that's just what we get up towards those 54s, 52 areas. So that's the next area of resistance that you're looking for. And then it's a case of, do we see a reaction from here? So we've now been up to 54, 55 area. Have we established a new range? So between those 54s, 55s, and perhaps we'd be looking down towards 45s. You see it flash down there, back down to 45. So we've pushed up and hit the most significant level that we've got around those 54s. And now we're back. And you'll notice consistently we've actually started moving up. So 20s held, 30s held, and now it seems that 40s are holding. So you're seeing some strength coming into this market. You now, a moment ago, had 1,000 lot as well chasing the market higher. So if we can get through 55s, can we then start continuing on further? No, we hold those 55s once again. So there's now perhaps another look down towards those 40s. So that's how you want to be considering it after the event. Consider each small range, and it is a case that you are likely to take a few losses and a few winners quite quickly in these areas. But once you establish that range, that gives you the opportunity to trade around the range as opposed to just sitting out if you're not in on the main move. So that's how we moved on that ECB in December. That preparation really did get you there. You had the trade lined up. As soon as the information came out, you knew exactly what you wanted to do with it. Sell the bunds. If you wanted to as well, you could buy the euro, or if the euro is the market you were going to trade, you could be buying the euro, selling the bunds, and then you're looking for those levels to the downside. And then secondly, what happens afterwards in terms of giving you opportunities to just scalp in smaller ranges. Let the market show you where it wants to trade, and then scalp those smaller ranges.
Okay, so you traded the event. Now, the biggest way that you learn anything from these events is not just by trading it and thinking, that was a good day, or oh, that wasn't such a good day. It's going through a debrief, going through a clear structure on how you're going to reflect on the event, where the opportunities were, what opportunities you took, whether you could have improved on any of those opportunities that you took. It's not all about picking fault in things you've done, but understanding what's happened throughout the trade, throughout the event, that's then going to give you more opportunity to learn and more opportunity to spot trades going forward. So first up, I try and break it down, just get the main bits of info down so that when you come back and look at a chart, you've got the context there with you. So first up, policy change. Was it expected? Was it not? This was definitely unexpected. Also note down forecast changes. Now, in this instance, a change in forecast was not overly important because of the way policy changed. So whilst we did see improvements in the ECB's forecast for inflation, for GDP, this was completely overtaken by the fact that asset purchases were reduced to 60 billion and for 9 months of an extension. Language-wise, equally, not a great deal either way. So use these tick boxes. It was both hawkish and dovish in a sense because of the fact it was neutral. We got neither. There were no clear signs. We had signs in the previous month about considering information come the December meeting, and that was all we got, and that was your hint. So the consideration forward into the December meeting. Next up, and this is where you actually start learning things. This is where you start finding out where your opportunities were. Was there another opportunity that you perhaps missed? What more could you be focusing on? And that's where you get down your chart and also why we got such a reaction. So you can see from the chart, we got a very, very strong reaction in the bund. Note down some of these things. The move in total was 125 ticks. That's a rather large move, bigger than any previous that we've seen, certainly in the first minute. And then we got a situation of consolidation, no secondary move lower, and then a move back up and a full retracement of the move. So you start questioning yourself, particularly around certain areas. What happened here that told you that perhaps we could be on for a reversal? What happened there that could have given you a trade? We all know what happened here on this first move down, these 125 ticks. What you don't always think about and don't always reflect on is, if you missed this move, or perhaps weren't ready for it, hadn't fully prepared for it, is there another trade? It's very, very easy, if a large move happens, to then become despondent, and in this area here, you then end up taking no trades on when there are opportunities. There's range-bound trade there. There are opportunities to take a few trades, waiting for levels, taking those trades on. Perhaps not taking the big move, not taking the 120 ticks, but you are still giving yourself opportunities, and this is a great way to reflect and see where you could be taking more trades on. Is there more in this for you than you might at first think? Because the obvious thing to think is one big move of 125 ticks, range bound trade of 40 ticks for the best part of an hour, and then nothing. And so you very quickly look back on these events and start thinking, well, if you're not in on this first move, there's nothing more to be done. Not entirely the case. So that's what you want to be noting down from charts. Also, big thing on these charts, what was the price action like in certain areas? What was the price action like here as we started to break upwards? How was this different to the price action here, where the market couldn't push on any higher? It couldn't get back into this little low volume area. So when you start considering those things, you'll then start noticing what exactly it is that allows you to buy the market here and stops you from buying it here. Likewise, what were we seeing down around about the 160.29 area that eventually created a low? What was happening during these parts of the move when the volume was very, very high, and also when volume not so high? As we come off a second time down towards 160.09, was there anything that could allow you to buy here? These are the things you need to be noting down on your charts. So annotate your charts fully. Write down everything you were thinking at the time as well, because that is key information. That will help you very quickly establish whether the trade was there or whether you were fishing for a trade potentially. So get all of those things down, and also why exactly we did it, why exactly we got the move that we did. And I've got that a little bit lower down in terms of the key things to be noting down. This 60 billion change. That's the key one that you want to be noting. 60 billion change. That was what created the move. Other than that, everything else reasonably similar. Note also, the news on rates came 1 second before the news on asset purchases. Yes, 1 second is a tiny amount, but 1 second gives you just enough time to actually collect your thoughts. You notice that rates haven't changed. Yes, this was fully expected, rates not to change, but it just allows you to sort of pause, see the next bit of the movement, and then expect that next time. You expect that you're going to get a slight pause before you get all the information. Finally, trade types. What trade type was it that you were looking for, and what trade type was it that was actually playable? In this example, it was a specified binary trade, in that there was a very specific number, very specific outcome that created a move. Other outcomes were not going to create a move. So if we had an unchanged or an extension for 6 months and 80 billion, then you would expect no movement. So it's what trade it was specifically that created the move and where the opportunities were there. Next up, you then, and this is the key bit, execution. How you execute these trades. Now in a moment I'll talk you through these 5 different types of trade as to what exactly that means and where exactly that allows you to get a trade on. This will help you out immensely for the drills coming up, because there will be a few different types of these trades, and understanding what then happens, not just in the first instance of the trade, but also how the market then trades afterwards, will allow you to start putting on more and more trades, because you're noticing the nuances of those trades, not merely, for example, hit and hold, which this one was, not merely you sell it and you wait and collect your money. There was something else that happened in there. So we'll go over, have a little explanation of these 5 trades you want to be thinking about. So hit and hold, a passive continuation, a breakout continuation, a fade and a reversal. So we've effectively got 3 different types of trade, and then the passive continuation and breakout continuation are the same type of trade. A fade and a reversal, equally the same type of trade. The hit and hold, slightly different. That's where you have to be very aggressive, as we saw in the video that has just gone by. So let's go and have a quick explanation of these types of trade. And here we go. So first up, we'll talk you through the hit and hold. Now in a hit and hold trade, this is what you use to trade a binary event, a specified binary event. You know exactly the information you want to see, and you trade that. You trade it very aggressively, as we just saw in the previous video, and then you expect an oversized move to start with that then continues. So say this move is to the upside, what you're likely to get is a move that surges very quickly, first 10 seconds, 30 seconds. You're then going to get still very aggressive moves, still very fast moves that then start to continue higher. So you might find that you get a pullback and some buying, and the market then continues to move in a more sort of flow way. The market will flow backwards and continue, flow backwards and continue. Whereas from a chart point of view, as we just saw, it looks as if it's gone in one straight line and just gone like that. Not really the case. So it's understanding what happens here, here, here that helps you stay in those trades. Visualize that pattern when you're taking these trades on, as opposed to just assuming that if you click, it's just going to keep going on side. What this allows you to do is when you do get in, say you get in here, it allows you to accept that the market is going to come back towards you. The market is going to make you feel under pressure, and then continue. And this type of trade is all about conviction. It's all about understanding what the information was that you wanted to trade and then staying with it. We knew, as we saw on that previous video of the ECB, that a reduction in stimulus was going to create a large move to the downside in the bunds. Having conviction is what kept you in that trade and allows you to maximize that trade. So, if it's not a hit and hold trade, and perhaps something that requires a little bit more interpretation, or perhaps the first move isn't clear as to why, but you do feel that there's another trade in it, you then are looking for a continuation trade. And there's 2 ways of playing a continuation trade. You either have a passive continuation or a breakout continuation. Now both are essentially trying to find the same thing. With a passive continuation move, you'll get a move, for example lower, that perhaps has broken a level. Or perhaps you've seen some kind of price action around this area here that tells you you want to sell it. So the passive continuation, as the market starts to come back up, you will have an order resting here, waiting to get filled, looking for the fill and then the move through the low. So your continuation, you're looking for a move through this initial low, but you're waiting for the move. You're waiting with orders resting in the market to get filled and take you through the low. Downside of this trade, the market may not come all the way back to where you believe that you can get filled, therefore leaving you with no position as the market comes off and then breaks lower. So that's your passive version. Now with a breakout continuation, you're not thinking about the previous areas to get in, you're not waiting resting orders. What you're looking for is the break lower, same level that we've broken, get the pullback, and perhaps we don't reach the level, and then we start coming back off, and you're looking then to sell it as the speed increases as we go through the low. So your aim is to sell it just before or at the low, looking for that break lower. It's a slightly higher risk trade in the sense that the market could dip below and then bounce straight back. But the idea behind this is you're not waiting for a passive entry higher up that doesn't come, and you're using price action. And this is where debriefing on your price action, what exactly you saw, is very, very crucial. Video your screens as well is highly recommended. That way you can see exactly what happens and start recognizing those patterns. So there's your two parts of continuation. You have your passive continuation and then your breakout continuation. Two different ways of effectively playing the same trade. And the key to this type of trade is understanding that this move does have more to it. Potentially, this is a technical break. That the market has a technical setup, perhaps it's positioned in a certain way that would make a continuation much more likely. And that way, you can then start paying these continuation trades from either way. Looking for the news to have helped the technical setup play out, and then the technical setup to actually play itself through. All right, so if we're not going to hit and hold, we're not going to play a continuation trade, what are we going to be doing? We're going to be looking for either a fade or a reversal. Now there is quite a clear distinction between the difference between a fade and a reversal. First up, let's have a look at a fade. Now the idea of a fade trade is that you will have a very clear idea of how far whichever market it is that you're trading is deemed as too far, perhaps, or you would deem as a long way for such information. So if you get a piece of information that you believe is not that market moving, or perhaps shouldn't create a move so large, and you get a very fast drop, the aim is, as you get the crescendo in volume, so you get the volume really spiking down into these lows, that's where you're looking to have a go at buying the market for the fast move back up. Now the danger of this trade is where you have your stop. You're not often buying it on a level, you're often buying it just purely based on price action, making it quite a difficult trade to know where your stop is. Ultimately, if you're buying it, your stop has at least got to be below that first low that it makes. And it could be a case that as the market comes off, you buy it here, the market then makes a low and then starts to bounce. And it's only once the market starts to come back up that you know where your stop is. But how far it is from where you buy to where the low is, you don't know as you're taking on that fade. So it is very much a case of it's a trade based purely on your observation of price action, how the market moves, where that crescendo volume is, and can you get in fast enough to take the quick bounce back up. Now this is slightly different from a reversal trade. A reversal trade will look a lot more at structure, at a way of giving yourself an in on the trade, rather than just trying to not guess but use price action purely to call a low. Now, a reversal trade could work in a couple of different ways. Say we have a level. Market moves lower, bounces back up, and then holds the level and starts to continue higher. Your reversal trade could work whereby you don't believe that the information you have received is enough to create a continuation or a hit and hold trade. So you're then looking for the market's turnaround. You've seen this level break, and you've then seen, as we've come higher, we've held the level again. So the level broke perhaps on the initial information, but as soon as we get back above it, the level comes back into play and holds. This is where you can have a go at buying the level, you can have a stop below the previous low, or even you can have a stop below the level and then buying it for the move back up, potentially for a full retracement of the move. The other alternative, even without a level, if you get some kind of bounce structure that helps you out, potentially you get a flag in the opposite direction. This is where you've seen the fast move lower, you've seen that volume peak, so volume's gone much higher. You then effectively create a flag, and it's on the break of that flag that you can have a go at buying it. So it's all about using a structure, using some kind of technical pattern that allows you in on a reversal trade as opposed to a fade trade, which has a much more aggressive nature to it and very price action based trade. So watch back any videos that you've made, have a look at how these things can play out. Now, if we go back and have a look at our debrief, you can see that there's a couple of opportunities for both reversals and continuation trades. Now, you'll remember in the video we mentioned 160.72. This bounce here came to 70, and this is where your passive continuation trade would not have given you an opportunity. We did not get filled if you were waiting at 72 and then the market starts to come back off. We sit in a range. This time, however, you do get the fill. Yes, it pushes up towards 80s, and yes, there is a possibility you could have got stopped out depending upon where you put your stops. So again, this is something to go back over. In a much more volatile environment, do you have to widen your stops a little bit before taking on a trade? But in both cases, if you were paying a passive continuation, you did not get the full move lower for the continuation. So in either case, you are likely to have got stopped out, if not taken a smaller profit or a trailing stop. So that was your continuation trade or passive continuation trade that we saw. Very limited opportunity for a breakout continuation trade. Really, that's where you'd be looking to sell through this previous low. We didn't get down there, so there's no breakout continuation. This was the hit and hold. We'll call it an H&H. And then also, you got the reversal trade. As we started breaking through 72 and 80 area, you then got the move back higher. So we've had three different trades here. So hit and hold, a passive continuation that didn't play out in the end, but it was still available, and then also the reversal trade higher. So go back over each of those trades, have a look at what was going on there. What were you thinking at the time as well? Did you recognize the chance of that passive continuation? Did you recognize the opportunity of a reversal trade as well? So they're the kind of things you want to be focusing on in your debrief. Every central bank should have a debrief following a very similar format. That way, you consistently go over things in the same way, and by using the same logical patterns that you review events with, gets them to stick clearer. It also allows you to get a little bit more thoughtful about what you can do in future, on future moves. By noting these things down, by noting down the facts of how things changed, just stimulates the brain to start thinking about other trades that are available, other trades that perhaps you wouldn't have thought about previously. So that's the importance of a debrief, and also an explanation of the different ways you can execute trades based on central bank events, or any macro event for that matter. Any kind of news event will have the similar type of execution on all trades. All right, let's move on. We're going to move on and have a look at some drills. And this is where you can start implementing some of those ideas, implementing some of those trades.